My suggestion for how the interest rate is meaningful to you in the refinancing world is do not refinance your house unless you have at least a half a point to a point difference in interest rate. Then it is valuable to you because things change anywhere from 5 to 10 years worth of ownership on a property.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
Today, I want to talk to you about your real estate education. Yes, your real estate education will directly make a difference in your real estate success. Right now, I'm doing a series having to do with real estate terms and what they really mean to you. I can define a term, and that will help you with your real estate education, but how is it useful? So let's talk for a minute. Real basic term, interest rate. Yes, what is an interest rate? Interest rate is usually what you're going to pay as part of your loan payment. It means the portion of a loan that is charged as interest to the borrower, typically expressed as an annual percentage of the loan outstanding. Now, I could go down the rabbit hole to talk about how your interest rate is different from your APR. Your APR, which is your annual percentage rate, is your annual percentage rate minus the effects of compounding, whereas your interest rate is the actual payment of interest that you're making on the loan, which in a 30-year loan or even an adjustable loan is the amount of interest you're actually paying, which is slightly more than what your actual APR is. So if you've ever noticed that your interest rate and your APR when you go to sign loan documents are not exactly the same, that is correct. The APR is the interest you're paying, the stated interest you're paying without the compounding effect, whereas the interest rate is the actual interest you're paying on the loan that you've just signed for. So, but how is an interest rate defined? How do banks come up with the rate of interest they're going to charge you on the loan that you're signing for? Generally, it's connected to one of two basic indices, the 10-year Treasury or the LIBOR, L-I-B-O-R, LIBOR. The 10-year Treasury or the 10-year T-bill rate is the rate that the US government is currently paying on their 10-year Treasury bills. Most major banks in the United States use the 10-year Treasury rate. It's Bank of America, Chase, Wells Fargo, often use the 10-year Treasury rate. It's what we look at every day when you bring up the Wall Street Journal or the financial section of the LA Times. The T-bill rate currently is 1%, 2%, 3%. Yet that's not what you pay. You don't pay the Treasury rate on your interest on your loan. You usually pay the Treasury rate plus a margin. Margins can be 2%, 3%, 4%. That's the rate you're paying. So you take the Treasury rate, the T-bill rate at 1.5% or 2%. You add the bank's margin. That becomes your interest rate. Okay, interesting information. Thanks to Christina. I like it a lot. Actually, let me give you one more piece of information. The LIBOR. The LIBOR is another indices that the bank might attach your loan to. The London Interbank Offering Rate. That's what LIBOR stands for. London Interbank Offering Rate, otherwise known as LIBOR, L-I-B-O-R. Okay, another common industry used more oftenly in commercial loans than used in traditional single-family loans. Okay, all that is interesting, and thanks, Christina, for the definition of what an interest rate is. Now, what does that mean to me? What it means to you is it means that it's how much interest you're going to pay on the money when you buy a home. Primarily a single family or 4 units or less is the focus of this particular conversation. I have a whole nother video that talks about what it means if you're going to get a commercial loan, i.e. a loan on a multi-unit, a retail space, office space. Those are commercial loans. This is your conventional loan that I'm talking about. What it means for you is that that's the interest rate you're going to pay. Let's do a little math, because how you use this is based on the value of the math. Okay? Because the most common question I get is, well, Christina, the interest rates have gone down. Shouldn't I refinance? I've got an interest rate right now that's 4% on my primary residence, and it just went down to 3.75. Should I refinance? And the answer is no, you should not refinance. I find it's the most meaningful at least a half a point difference. So it needs to go from 4% to 3.5%, preferably a full point difference. Let's do the math. Makes the difference it makes is for every $100,000 you have, if you change your interest rate by 1%, right? Not the total interest rate, the change in the interest rate, it goes from 4% down to 3%. What's your effective savings? Your effective savings across the year for $100,000 in interest rate is $1,000. That means a little bit less than $100 a month is the difference on your payment. Over 30 years, that's $30,000. To me, that is not significant. Here's part of why. When you go to refinance, you're going to pay a point. So you're going to pay at least a year, if not 2 years worth of saved interest on your note just to refinance. So if you're only going to keep that loan for 5 years, why would you pay a year or 2 years, a point or 2 points in refinancing fees in order to keep the loan for another 5 years? And why am I saying 5 years? The reason why I'm saying 5 years is because at least the last time I heard this number, which might be literally 10 years ago, people generally refinance their single family home about once every 5 years. So if I want to refinance my home, and I know that I'm probably going to keep it because most people keep it about 5, let's call it 8 years, is a half a point worth it? No, not really. You see, you pay a point to refinance. You pay 2 points to refinance, depending upon what bank you're using. If it's a half a point, then it's going to take me 2 years. 2 years. If I have a half a point difference in my interest rate, it's going to take me a minimum of 2 years to regain my refinancing fees in value. If it's a half a point and I have to pay half a point in your interest and you have to pay a refinance fee of 2 points, that's 4 years to regain the value that you would receive by refinancing. And again, in 5 to 8 years, a lot of things change. So therefore, my suggestion for how the interest rate is meaningful to you in the refinancing world is do not refinance your house unless you have at least a half a point to a point difference in interest rate. Then it is valuable to you because things change anywhere from 5 to 10 years worth of ownership on a property. That's number one. Number two, interest rates when you're booking a loan. Oh my God, Christina, the interest rates are so low. I've got a 3.75 interest rate available to me right now, and they just changed it. They changed the interest rate to 4. Oh my gosh, I'm so disappointed that I've just lost that quarter of a point in my loan. Should I reshop my loan to see if I can get a better rate? Now, you guys can guess my answer. What's my answer going to be? No, a quarter of a point is not worth the price, the time, the effort of you reshopping your loan, especially since by the time you actually close that loan, your interest rate may have moved again. So that's 2. You want to see a difference, I would say, of at least a half a point to a whole point of interest rate difference before you think about reshopping a loan you've already pretty much are in the queue for. Number 3, should I pay down a point on my loan in order to save interest long term? The answer's in the math, guys. 1 point may not make one point now will be meaningful if you're going to keep the loan longer than 5 years. If it's truly your primary residence, not something you're going to be refinancing money out because it's an investment property in 5 to 10 years, right? If it's truly going to be a 30-year loan, then yes, absolutely. Lock in your rate for a half a percentage point. Sometimes it's as low as a quarter percentage point. You see that makes a big difference. Because if I lock in my rate and it moves by a whole point, that's meaningful over a long-term period of my loan, if that's the intention of the house I'm holding. But if you're only going to hold that house for 3 years to 5 years, or even worse, if you're going to do it for a flip, that interest rate is not that meaningful. If you're only going to flip it and you're going to hold the home maybe 2 years, which hopefully you're not going to hold it for 2 years if it's a flip, but let's just say it's 6 months to 2 years on a flip, because sometimes it takes 2 years to finish a flip, which I know personally, then no, your interest rate is not sensitive, which is why a lot of flippers pay twice the normal interest rate on their hard money loans in order to finance a flip. Instead of paying 4% or 5%, they'll pay 8% to 10% on the hard money loans if they can get a flip done in 6 months in a reasonable amount of time. The interest rate is just not that sensitive, guys. If you were to learn anything from my conversation today about interest rates and the 4 different places I just talked about where interest rates can affect you, which is the purchase of your home, locking in the rate on your home, refinancing your home, or doing hard money versus conventional money, the interest rate just is not that sensitive. It gets sensitive when you start getting into the $2 million, $3 million. But again, the first 3, which is refinancing your home, the interest rate on your home, or locking in a loan, you're still paying. The percentages still work the same. 1 point is still a point, whether it's on 100,000 or whether on $1 million. So paying a point has the same mathematical effects, but you might be more meaningful to you when the interest rate effect is $30,000 or $300,000. That's when it can become much more meaningful to you. So keep into mind the amount of the loan in order to practice the math. Always go back to the math, guys. When will it be meaningful is at the point of the math. Thank you so much. Interest rates, real estate terms, and what they really mean to you as an investor. This is Christina Suter on Real Estate Breakthrough Show. Make sure that you tune in either on Roku TV or YouTube, which we post twice a week, or whether it's on iHeartRadio, Spotify, or iTunes. You can listen to this podcast verbally, or check me out on ChristinaSuter.com if you want to book a session with me, or if you want to find out more about my mastermind course, and this is the type of stuff I teach in my mastermind course, ChristinaSuter.com.